but mostly it is a way for us to know where we are, what is happening behind us, and how do I look? Okay. I want to apply it to the world of finance and economics because I am studying econ in high school, and that will be my major. Mirror of a market. When we say mirror of a market, what comes to your mind at first? Brainstorming. The stock market, yes, it can be one. The futures market, yes, why not? The Federal Reserve, the CPI rates, PPI rate, all sorts of terminologies, these can all be the reflection, be a part of the mirror of the economy. I know that some of you may be familiar with these things already because you may be going to work for finance or bank in the future, but still I'm going to give a brief introduction about them so that everyone knows what I'm talking about. Firstly, let us think about what is the stock market. It is a market where firms trade a part of its share to get some more investment. There are two ways for you to get money from the stock market. The first way is through dividends. It's the money you get from a part of the company's profit. The second one is what everyone is desiring for. It's called capital gain. So you think a company is going to do well, you invest in somebody at a lower price, and then after a period of time, the price rises, and then you make a huge fortune from it. Millions of people around the world dream of getting rich through the capital market, and that is why the stock market can be a reflection of the economy, because so many people participated inside the stock market. Okay. The second thing I want to talk about is the Federal Reserve. It is the central bank of America. Why do we talk about the central bank in the US, not in the UK, not in Japan, not in China? Because the US market affects all of us. What does the central bank do? Basically, it conducts monetary policies. It makes interest rates, it sets up the Federal Reserve rate, it decides the time for a quantitative easing where it's time for it to spread and to put money into the market. This is basically what the Federal Reserve do. And why do we talk about the interest rate? Why is it very vital? Because interest rate decides the amount of investment and the amount of money available in the whole market. So when the interest rate is high, there is a high cost for businesses to borrow money. When the interest rate is relatively low, you are going to deposit that, however it's good for businesses. Businesses are going to invest more, they're going to borrow more money and expand the whole economy. So if the interest rate is too high at some point of time, it will be bad for the whole economy. And these are the basics I would like to talk about. Now we're coming back to mirror. The stock market is the mirror of the economy. So if the economy is doing well, normally the stock market does a good job. You are going to see people spending a lot because they earn from the stock market. You may see prices rise due to the increase in consumption. In the 1920s, before the Great Depression, America was at its so-called best of the times. In the 1980s, Japan, the Japanese almost bought America. So when the stock market is doing well, the economy, it seems to be doing well as well. However, this does not always work. Some people, they thought this was the true reflection of economic fundamentals. They believed the market was rational and therefore all the bubbles, all the thriving facade is rational. However, if you pay attention to the economic fundamentals, this was not in an optimal condition at the time. Since the early 1920s, let's take the Great Depression as an example. The world was experiencing the aftermath of World War I that made Europe pay heavily in terms of debt. Germany, France, and UK, they owe the US a huge amount of money, and they were not able to pay it back. So this greatly made the Americans' exports suffer because the foreign countries, they don't have the ability to consume the overproduction inside the country. At the worst times, let's take Germany's example, is experiencing hyperinflation. One golden mark is equivalent to $1 trillion. This was an insane number. So when you look into the mirror, you're going to see your surrounding environment is actually extremely dangerous. You are just like dancing in the middle of the desert, and outside the desert there is an ocean full of sharks and giant squids that's going to eat you at any point of time if you were not careful enough. The economy is like a car. And there is no time or opportunity to look back. So that's why a car has got a mirror. An economy must also have a mirror. So Americans' overproduction and overconsumption at the time came to an end before the surpluses, because the surpluses created can barely be exported. With the stock market reaching an all-time high and the slowing down economy, you'll see a bubble. Some people call that a rational bubble. These people, they still work for the central bank. The Federal Reserve till now is still a faithful believer that the market is rational. At first, what they did, according to their assumptions, was to raise the interest rate because they thought it's going to decrease the investment. However, I previously mentioned they thought there was a great move to stop the market from collapsing, but people are not absolutely rational. They were scared of the upcoming collapse, and they were right. The whole market collapsed because more and more people, they went to panic, more and more people, they sell their stocks, and then the market collapsed. So you're going to see there was a bad world economy, the market went crazy, the surplus cannot be exported, false policy, these all created the Great Depression. So we must learn a lesson from disasters in the past. Now it's 2021. We are experiencing the aftermath of pandemic. The central bank now knew that they have been lowering the interest rates for decades. In this pandemic, they have injected too much money into the market. They're going to see how crazy the whole market goes. The stock market in the US has reached another high place. Bitcoin last month went through $60,000. Unfortunately, it fell down, which means the people became rational again. Meanwhile, we have seen the difficulties of the supply chain globally. Look into the mirror, and you will see how dangerous our surrounding is. Are we in a downturn? Technically, we are. But why is the market still expanding? We must be cautious of that. I am not professional at all. But let's take a real-life example telling why sometimes it can be obvious to see the market runs crazy. Last year, in 2020, I think lots of the parents, or even you, were interested in something called mutual funds. In Chinese, it is called 基金. I did invest in it as well. I earned 37%. I was so happy that I thought I could compare with Warren Buffett. And then my dad told me, Jimmy, it's time to leave. I asked him why. He said, when everyone, even you, is gaining money from the market, it's time to leave because the market went crazy. It cannot really distinguish who should get some money and who should not. And I didn't listen to him. I thought, no, I'm heading for 50%. So anyways, off you go. Then he was right, and I was wrong. Earlier this year in March, because the US bond market, the bond rate was a bit higher, and the Chinese market collapsed earlier after the Spring Festival. So one important thing to know is watch out for people around you in the market. If even your grandma is asking your dad what stocks to buy, time to leave. Seriously, this simple rule applies. I've just introduced the first two things to look at in the market, in the mirror. Sentiments of the market and the outer environment. And then comes to the third thing we can care about. Remember the policies of the Federal Reserve? We call that monetary policies. The central bank has always been the doorkeeper of a market. When things are bad, they lower the interest rates and purchase bonds to bring liquidity, which means to bring money back to the market. The US has been using this method for decades since Alan Greenspan, the 13th chairman of the Federal Reserve. If the central bank found that inflation is at risk, they start the taper. This means they will stop the current policies and eventually, gradually. And in China, this has another meaning, it's called soft landing, 软着陆. These policies, they manipulate the investors' expectations, and therefore this was called expectation management. Always care about the monetary policies, and you will know what the people out there think of the whole economy. It is hard to understand their true intention, but be cautious every time. We just went through a couple of things to look into the mirror of the market and the economy as a whole. Analysts are those who try their best to find the sentiment of the market, who try to wipe out the fog covering the mirror and see the environment, no matter it is the policies or important data. And with these together, a trend is formed in the market. My speech today is merely a briefing of the art of prediction and evaluation of a market. Remember, look into the market every time and see what is inside. Thank you.